What is a balance sheet? Very simple. In one line, I'm going to tell you, and your life is going to change forever. Balance sheet is a snapshot of a firm's financial position at one point in time. A snapshot of your financial position. In one shot, you get to see how your financial position is. Is it good? Is it bad? Is it in the middle? That's all you need to know. So let's celebrate that you already know what a balance sheet is. Yes! Fireworks! Party, party! Woo! Beep! Boo! Ba! Boom! Boom! Ba! You wish it was as easy as that, of course. Well, that's the main definition. Balance sheet, financial position, good or bad. But you have to be able to know how to read a balance sheet, and for that you need to know at least 3 terms. By the way, when I do these things, I sometimes forget that I have other things. The snapshot usually happens every 12 months, right? Typically at the end of your fiscal year. So this is what your accounting is going to do. It's going to create a balance sheet for you so you can see the snapshot of your financial situation at the end of each fiscal year, which typically is at the end of the year, it's December 31st, how the company looked at that point in time, or sometimes March 31st, which is my fiscal year in my case. Also, there could be balance sheets quarterly, just so for bigger companies, they want to make sure they have this either quarterly or even monthly to see how the company is looking at that specific point in time. So now that we celebrated, what's next? We're going to have to learn these 3 important terms that make up a balance sheet, which are assets, liabilities, and equity. So the balance sheet, they're called balance sheet because they need to balance, and what they're balancing are the assets, and they should balance out with the summation of liabilities, or the addition of liabilities plus equity. And this is like gibberish. This is complete gibberish unless you understand very well what these 3 terms mean. So that's what I'm going to do. Define them. So term number 1 is assets. Assets are those things the company owns, such as its inventory and accounts receivables. Before I said accounts receivable are part of your assets, not all your assets. Inventory, well, if you have a lot of product in your warehouse and you own it, that's part of your assets. Anything you own, physical or non-physical in the case of accounts receivable, are your assets. Liabilities are those things the company owes, such as what they owe to their suppliers, which in this case would be accounts payable, bank and business loans, any money that you borrow, those are liabilities, mortgages, and any other debt on the books. Obviously, the less liabilities you have, the better, but these are part of this equation in the balance sheet. And finally, you have the equity, which is the ownership the business owner and any investors have in the firm, also known as net worth, net assets, or capital. Some people refer to equity in different ways, so it's important to know that it could be called 4 things: net worth, net assets, capital, or equity. Typically, it's equity, and these definitions, like a lot of these definitions, I don't invent them. They come from different places. In this case, they come from a company called bizfinance.about.com. Fantastic. So now let's see an actual balance sheet, at least a prototype of a balance sheet, to have an idea of how these 3 terms interact with each other, and then I actually show you an actual balance sheet and read it. Learn to read it, because this is going to be hopefully very useful for you in the future. Hey, did you enjoy this video? If you want to see more like this, just subscribe here. If you want a free gift, click here. Yeah. Which one is going to be the one you click? La 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 la.